Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 27th of July. Let's dive into the week's top market news. Balancing tariffs, energy spikes, and political shifts. European markets hold their ground. European equities managed to carve out modest gains over a chaotic week, proving surprisingly resilient in the face of escalating geopolitical friction and renewed trade threats. The Pan-European Stocks Europe 600 index ended up 0.46% in local currency terms, as investors continually weighed generally robust quarterly earnings reports against a turbulent macro backdrop. Wall-to-wall headlines detailing heightened tensions in the Middle East, sharply higher crude prices, and fresh tariff announcements from the Trump administration targeting dozens of trading partners, including the European Union and the UK, kept traders on high alert. Performance varied across the major bourses, with Germany's DAX leading the charge up 1.08% and the UK's FTSE 100 climbing 1.28%. France's CAC 40 eked out a 0.40% gain, while Italy's FTSE MIB was the lone outlier, slipping 0.15%. Central banking matters added another layer of intrigue to the week. The Governing Council of the European Central Bank chose to keep all three of its key interest rates unchanged in a unanimous vote. However, ECB President Christine Lagarde delivered remarks that were far from complacent. Pointing directly to the breakdown of the ceasefire between Iran and the US, she highlighted serious developments across commodity markets and emphasized that the central bank is closely monitoring the intensity and duration of this renewed energy shock. Markets quickly digested her comments as a signal that monetary policy is far from locked in, leaving the door wide open for another potential interest rate hike in September. On the economic health front, the underlying data provided a mix of encouragement and underlying concern. Manufacturing activity across the Eurozone accelerated in July, with the S&P Global Flash Eurozone Manufacturing PMI climbing to 52.0 from June's 51.4. The services sector also staged a strong comeback, returning to growth with a PMI reading of 51.6. beating expectations of 49.8 and marking a clear rebound from June's 49.4. Yet, this positive momentum failed to lift consumer sentiment everywhere. In Germany, consumer confidence softened further as the GfK Consumer Climate Indicator slipped to a worse-than-expected -29.6, driven down by weakening expectations surrounding personal income and financial outlooks. Across the channel, political developments shared the stage with a flurry of positive economic data. Andy Burnham officially took office as the UK's seventh Prime Minister since 2016, immediately pledging to cut taxes on household energy bills by scrapping the nation's digital ID program. Emphasizing regional devolution, Burnham also surprised markets by naming former Secretary of State for Defence John Healey as the new Chancellor of the Exchequer. Despite the political reshuffling in Westminster, the UK economy produced several encouraging figures. UK services activity returned to growth as the S&P Global UK Services PMI jumped to 51.8 in July, soundly beating the consensus estimate of 49.4. Adding to the optimistic economic picture, the Office for National Statistics reported that monthly retail sales volumes surprised significantly to the upside, rising 1% in June against market expectations of a 0.3% decline. Now our insight into alternative markets. M&A in Europe. A quarter of transition. The European M&A market went through a phase of consolidation between April and June 2026, following a record-breaking first quarter, but the narrative emerging from the data is not one of worrying slowdown, rather a return to more sustainable rhythms after a bout of hardly repeatable euphoria. According to WTW's quarterly deal performance monitor, produced with the M&A Research Center at Bayes Business School, European acquirers closed 38 deals above $100 million, down from 40 in the previous quarter, with share price performance underperforming the regional index by 8.3%. This figure, however, when compared with the much sharper underperformance recorded in North America and Asia Pacific, places Europe in a relatively less eroded position compared to its main global competitors. Looking instead at PitchBook's aggregate figures, which consider the broader universe of transactions including mid- and small-cap deals, the European picture appears even more solid. Total deal value fell by only 6.4% quarter-on-quarter to $344 billion, a much more contained contraction compared to the 24.3% drop suffered by North America over the same period. The number of completed deals actually rose by 0.9% to 5,061, a sign that beneath the surface of mega deals, the market continues to grind out activity at a robust pace. The bright side: resilience and selectivity. The most interesting takeaway from this quarter concerns precisely the European market's ability to remain active even amid geopolitical volatility, uncertainty over trade policy, and rates in motion following the European Central Bank's surprise rate hike. Dealmakers didn't stop, but simply recalibrated their priorities, shifting toward smaller-sized transactions with greater execution certainty. The B2B sector stood out as the continent's most dynamic segment, with deal value up 35.6% quarter-on-quarter to $129 billion, a signal that industrial demand and sector consolidation processes remain alive even when the macro cycle is uncertain. Anderson's data confirms this pattern. European M&A reached €262.5 billion across 3,315 deals, while private equity recorded €30.6 billion across 1,311 deals, evidence of continued, albeit more selective, capital deployment. The UK, Germany, and Italy remain confirmed as the three most active markets by value, with financials, industrials, and high technology leading strategic dealmakers' preferences. Worth noting is also the emergence of peripheral markets such as Ireland, Sweden, Denmark, and Finland, which are attracting growing attention thanks to innovation and sustainability themes. Investor trends. The common thread running through this quarter is valuation discipline. Both strategic and financial investors are favoring higher quality assets with execution certainty rather than chasing volume at any cost, which explains why the gap between total value and deal count continues to widen. WTW's Andrea Scafidi highlighted that, despite sharp swings in deal activity driven by an unpredictable macroeconomic and geopolitical backdrop, acquirers have almost never stopped and continue to brave volatility in order to seize opportunities. On the private equity front, the picture is even more nuanced. Exit activity reached record levels, with €157.6 billion in total for the quarter, but nearly two-thirds of this value is concentrated in just 22 mega exits, meaning that the recovery, while real, remains fragile and polarized around a handful of large-scale transactions. Technology, healthcare, and the energy transition remain the central investment themes for the rest of the year, supported by gradually improving financing conditions and strategic demand that shows no signs of running out of steam. Deals setting the direction. Globally, a few giant-sized transactions continue to shape market sentiment. The $118.5 billion merger between Dominion Energy and NextEra Energy and the $60 billion deal linked to Cursor alone contributed to keeping the aggregate global value high. even against a backdrop of essentially stable deal count. For Europe in particular, this quarter's lesson is that the ability to generate value no longer depends solely on deal size, but on the strategic quality of assets and the soundness of the industrial rationale underpinning each transaction, an approach that, as highlighted by WTW analysts, will be decisive for creating value even in turbulent conditions like those expected for the remainder of 2026.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.